Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and a special video for you today. And those of you in the nation will remember, we did a series on investing in gold about 4 months ago, March 20th in fact. And in the 5 months since, the price of gold has surged 28% and reached an all-time high just recently. But I wanted to give you an update because we're starting to see that price kind of bounce around a lot. And I know a lot of you are asking if gold is still a good investment. So not only are we going to look at why you should be investing in gold, how to know where gold prices are going, we're also going to get the insight from an insider in the industry, the chairman of a $300 million gold mining company, to give us his experience in the market. Now, I want to get right into it. We're going to have the chairman on first, and then we'll talk about those supply and demand fundamentals to show you how to know if gold is still a good investment now or whenever you're watching this video. So I want to bring on Amir Adnani, chairman and founder of GoldMining Inc. That's ticker GOLD in the TSX, that's Toronto, and then GLDLF here in the United States. The company is a $300 million miner with projects in Brazil, Canada, the United States, and Colombia. Amir directs the company's resource acquisitions across the Americas. He's also the president and CEO of Uranium Energy Corporation, that's ticker UEC, and one of Fortune magazine's 40 Under 40. And when I heard that we could get Amir on for the interview, I had to check out the company's stock price because, well, I'm nosy about that, and was blown away to see that gold mining was up 113% over the last year versus shares of the GDX Vectors Fund. That's the fund of gold miners, and it's 46% run. So hopefully, besides that insight into gold prices, he'll let us in on what to look for to find those competitive advantages in the gold miners. Amir, thank you for joining us and offering your insight.
It's my pleasure to connect with you today.
So gold and silver both up 100% since the lows, all-time high in gold. A little bit rocky though lately. The stock market isn't crashing. Inflation is nowhere in sight. So what do you attribute this increase in prices to, and how high can it go?
There's a structural shift in the investment thesis for gold. It used to be that gold, and believing that gold is going to go to $3,000 an ounce, was limited to the gold bug audience. And now it's emerged that Bank of America thinks gold price is going to go to $3,000 an ounce. And it's become a must-have asset in almost every portfolio. Whether you look at the relationship to the 10-year treasury yield at almost minus 1%, the ongoing printing of money and debasement of fiat currency argument, whether you're concerned about geopolitical risk, whether you just think it's kind of crazy. I mean, I've got young kids. If you have young kids and you're thinking about their future and how they're going to pay for all this debt that's being accumulated as a result of what's going on this year. Not to mention, before COVID happened, we were already at the tail end of a decade-long low interest rate environment. And now the Fed says they're going to keep rates lower at zero or practically zero for at least another couple of years. There's a part of this that just depresses me because, again, I think about the financial and economic consequences and consequence of this down the road. As an entrepreneur and someone that believes in the power of entrepreneurship, I think to myself, what's the motivation for people to innovate and create things when they're going to be taxed to death when all of this is over? And it's not right, but it is what it is. And so as a result, you got to think about the role gold can play as the haven of last resort, as the only asset class that the Fed can't print. The Fed can't print gold. That's where the big difference lies. And I think the gold prices, Bank of America says $3,000. Forget Bank of America. I mean, those numbers completely make sense in the context of record debt or debt that has been created that gets compared to the level of debt the world had at the end of World War II. World War II took many years before we arrived at the end of World War II. In 90 days, we've created more debt worldwide than we had in the world at the end of a major world war. This is beyond mind-boggling.
It's unprecedented, and I'm glad you brought up Bank of America, because I think Goldman actually came out with a $4,000 price target. So definitely a lot of these bigger banks and coming in, and actually we did just see consumer prices over the last month were up 0.6%. I think it was reported. Of course, it's still only about 1% over the last year, but definitely starting to see some of that money printing, that excess money printing come through, and that potential for inflation. So now talk to me about the supply side, because we'll talk about the demand side for gold here in a little bit. one of the key drivers. I know supply tends to be fairly constant, and of course, they say all the gold ever mined is still in circulation. So, talk to me about the supply side. I've heard a lot about miners pulling back on capital investment and capital spending through that 2013 to 28 period. So, is that going to affect supply and maybe help support those prices higher?
As we come into a bull market for gold right now, we must remember that the past 8 years, we were in a bear market for gold. Gold prices were closer to $1,000 an ounce compared to $2,000 an ounce. As a result, major gold producers completely got rid of any spending that had to do with exploration and development. Mining is a depleting business. You deplete the ore bodies, the mines that you're extracting gold from. As they get depleted, you must invest in exploration and development. Think of it as research and development to come up with new resources, new reserves. And if you're not investing in that, you basically run low on those pipelines. So today there's, compared to a decade ago, we're 50% lower globally when it comes to major producers' reserves and resources. And that's because they've starved their pipelines of capital needed to grow, because they were focused on reducing their debt and protecting dividend yields during a prolonged bear market that we had for gold. So there are for sure another underpinning of the higher gold price that we're witnessing is going to be driven by structural shortages and physical shortages of gold because of underinvestment for a long time.
And that's
With
an
the higher
interesting.
gold, yeah, sorry, go ahead.
That's an interesting point because with towards the beginning of this year and the end of 2019, we were seeing a huge wave of consolidation. I know the largest gold mining companies in the world were shifting back and forth just because a couple of the majors were adding, were acquiring to fill in that pipeline, that pipeline deficiency. Do you think that's going to go forward? I'm actually thinking about it now. Kind of surprised that we haven't heard about more consolidation in especially the junior miners, getting added in to bulk up the pipelines.
You're going to see more and more of it. So I think you touched on a point that is a trend that started exactly as you said a year ago. Whether it's the gold sector or the biotech sector, consolidation on a wide scale always starts when the big boys put on their big boy pants and they merge and create bigger entities. And that started a year ago with the super majors, the Barricks, the Newmonts, creating bigger entities through the Newmont Gold Corp merger, through the Barrick Randgold merger. And since then, you've seen, and it goes from the biggest, then it just works its way down into medium-sized companies and then small-sized companies. And that's happening right now. And it's going to, in my opinion, pick up a lot of momentum and steam. Because if you were to go out there and look for gold from scratch, from grassroots exploration, it could take minimum 10 years before you even get to a point of permitting a mine. So you got to fast track. In order to fast track, you're going to go and acquire projects that have already been explored and drilled and defined to some extent. And so they're a bit more shovel ready. And that can accelerate the much needed requirement to replace these depleted portfolios that these intermediate and large and superpower producers have. So look, it's you got to, in every industry, I think, anticipate what is next. And with $1,900 gold going to 2,000 or thereabouts, obviously it's up and down every day. The next wave is going to be the intensifying and the momentum and M&A cycle most likely picking up, in my opinion. And you touched on it.
Yeah. And I want to give you time to talk about gold mining. Nick, I want to put it in the context of how investors can look at gold miners, pick the best gold miners to invest in. Obviously, I think you've got something there vastly outperforming the GDX Gold Miners Fund. So talk to us about some of the things that you've done with the company to be able to produce that return. How investors can look at gold miners. I know GoldMining Inc. is trading around a 52-week high after some big developments were announced. So how do these affect the company going forward?
If you're interested in any commodity, if it's gold, and you look at the underlying commodity price, almost always well-run, well-structured companies that are going to either own gold projects or going to mine them, we should provide an outperformance or leverage to the commodity price. This is, and it's because of the fact that you get much more margin expansion on revenue. Your resource in the ground starts to trade at a higher multiple. And all of those percentages end up being a greater move than the percentage move in the commodity price. So to your point, we've seen an outperformance in the shares of our company by a fairly wide margin compared to where the gold price, with the move in the gold price. So the gold price is up 30%, for example, and we've been up close to 100%. And so that's, and I'm rounding here, depending on which point you take in the last 6 months or 12 months. So you see that outperformance, number one. Number two, I think as investors, you want to look at the style and philosophy and the strategy of each company. Our company has a strategy where, first of all, when I speak to you as the chairman of this company, I'm also the founder of this company. I'm also the largest individual shareholder in this company. You don't get that with the large cap companies. Typically, management are capable, but they're hired guns. They don't have as much skin in the game. I think in our instance, you look at the people responsible for talking about the company, making decisions about the company, and we're owners. We're owner-operators. We have skin in the game, number one. Number two, our style and my view was that we should be buying gold properties. We should buy gold projects when gold is out of favor because you can get a much better price. It's like the whole idea that you buy your Christmas decorations in January or July instead of December. So we were buying gold projects starting back in 2010 when the gold price went into a bear market in 2012, when the gold price was much closer to $1,000 an ounce, including in 2015, we were buying assets. So our company was built very much on the foundation that we took maximum advantage of the bear market in gold, which lasted 8 years between late 2011 and almost 6 months ago, basically, when it came out of that. And now we have a bull market in gold, but we paid basically 10 cents on the dollar for the asset base that we acquired. You know, we spent $81 million acquiring our portfolio, and the same portfolio of companies that we acquired, which used to be public companies, in 2010 had an $850 million market cap, literally 10 cents on the dollar. And the difference is $1,900 gold versus almost $1,000 gold. So in that sense, you get a feel for what is our company all about, and now what are we going to do next? So that's where we're coming from. What we're going to do next is harvesting the strategy and this portfolio. You bought low, you've accumulated during cycle lows, and now we're going to look at this in two distinct ways to create value. One, we're going to advance the portfolio of assets that we own 100% and look to joint venture them, look to sell them, look to develop them on our own. We've got multiple ways we can do that. But second, what is extremely attractive and popular today in the markets are royalty companies. And companies that are in the precious metal sector that are focused on royalties are trading, in fact, at higher valuation multiples than the miners themselves. Because royalty companies don't assume the operating risk that goes with being a miner. They simply get a royalty or percentage of revenue. That means you don't have all the problems and headaches that go with mining. So we have created a royalty on our entire project portfolio, which spans 14 projects, 5 countries in the Americas, the United States, Canada, Colombia, Peru, and Brazil. Over 12 million ounces of gold in the measured and indicated category, 13 million ounces of gold in the inferred category. It's one of the largest gold resource portfolios of any pre-production company. And we've created a royalty on all these projects and put them inside of a newly created company called Gold Royalty Corp. So now if you're a shareholder in our company, you get exposure because Gold Royalty Corp is 100% owned by us. So if you're a shareholder in our company, you get exposure to Gold Royalty Corp and 100% ownership of this portfolio of assets that was acquired during the bear market. And then to run the Gold Royalty Company, we've brought on board the former CEO of Goldcorp, a guy named David Garofalo, a gentleman who basically merged Goldcorp last year with Newmont to create the world's biggest gold producer, New York Stock Exchange, Newmont. And that's the kind of pedigree of management team that we've attracted. And those are all things that I think go back to your question. What should people look for? I think people should look for a credible management team with track record, with skin in the game, and with a clear strategy that they can articulate. And also, because we're in a bull market, you don't one shows up and says, I want to be a gold company because gold is hot. Were you there over the last decade when it was in a bear market to take advantage of it? Because that's how you create value, by taking a long-term approach.
Okay, excellent. So now this Gold Royalty Corp is structured as kind of like a royalty trust, like an MLP kind of thing, or
it's a corporation. It's a corporation that will own 14 royalties on our 14 projects, ranging from 1% to 2% net smelter return. So that means a percentage of your revenue. It's going to hold those royalties. It will look to add to royalties through other acquisitions. It as a separate corporation, we will look to potentially spin it out or do a separate initial public offering. And that way it basically, again, becomes much easier to value it because it's not entirely inside of our company. So it'll end up becoming two public companies out of one, which is our company today, GoldMining.
Interesting. So obviously then shareholders of GoldMining Inc. will be split off and will have shares of both companies. And then if it does issue shares, then.
To be clear, we haven't defined the specifics, the mechanics of how that would work. Okay. It may be that we would do exactly what you said. It may be that it will simply list and GoldMining will retain its share ownership in that company. The exact structure, what we've said so far is that we're going to evaluate all these structures and do what seems to be the best for all shareholders in the company. I can tell you, as the largest individual shareholder of the company, obviously that alignment that we have as management and as the board with our equity holders has been a tremendous part of our story to attract institutional shareholders. We have IM Gold, which is an intermediate gold producer, a company with 5 billion market cap as a shareholder. One of the biggest resource investors in the world, Sprott Global, which is listed on the New York Stock Exchange. They've been shareholders of ours for close to a decade. So that everything that I'm talking to you about is also really validated through the pedigree of investors that we have attracted as holders to our company.
Okay, excellent. Some great information. So yeah, looking at gold miners, looking at what they've been doing over the last 10 years, really, have they been acquiring those assets and using that to leverage up really their profits right now. Some great insight. Thank you for sharing all this. Stay tuned out there because now we're going to take all of this and show you how to look at gold as an investment. A few ways to invest, including gold miners like GoldMining Inc., as well as that physical investment. But I want to thank Amir Adnani, chairman and founder of GoldMining Inc., for his insight today. Now, supply of gold is fairly stable, but has those cyclical variations, mostly just after that long period of lower prices when miners are pulling back on their capital spending, their investment in new mines and acquisitions. So you get that opportunity to see consolidation and then supported prices for at least a few years after that. Demand, on the other hand, is really where you're going to get that year-to-year variations in price because some of these can rise and fall pretty quickly. You've got four major sources of demand for gold here. First is investment demand for gold, which includes physical gold holdings and then the ETFs, those funds that hold that physical gold. And this is actually a fairly small portion of demand compared to some of these others that we'll talk about, but can affect prices at the margins. And besides the return, though, an allocation to gold helps to protect against inflation and just the loss of the value of dollar. And over the last 3 decades, annual volume of gold held in portfolios has increased by over 200%, according to the World Gold Council. So definitely an increasing interest from investors into gold as a hedge as well as a return. Next here is central banks, and these are going to be holding gold as a safety asset along with their U.S. Treasury notes. But what we've seen is a real shift away from treasuries and the U.S. dollar, especially by Russia and China over the last 10 years. In fact, central bank buying of gold has increased for 10 consecutive years and is likely to keep rising at that pace. Jewelry is actually the single biggest factor at around 50% of total demand for gold, with India and China accounting for about half of that. Jewelry demand rises and falls with the price, but that financial progress of these two countries and the billions of people entering that middle class means there's always going to be demand here for more gold as jewelry. Next here in the demand for gold is going to be the industrial and technology sectors. Gold is actually one of the best conductors of electricity, so it's used in a lot of electronics products. Now, this is usually the most cyclical source of demand because, of course, when the economy slows, you're going to have less electronics, less industrial needs. They're going to be buying less gold. But it is also around this time that investors move into gold as a safety asset. So there's something of a counterbalance on this one. When the economy falls and these industrial sectors need less gold, then that's when investors are usually picking up the slack. So a lot of those demand factors are going to be supporting the price of gold. And I think investors should have some exposure to their portfolio even after that 28% run since March. Of course, the question here is how to invest, really, whether it's in physical gold or in stocks, those miners or the ETFs. Now, we have talked about investing in physical gold before, and I hold some here, but there are some drawbacks. Okay, the fees are usually pretty high, usually around 4% charge on each side to buy or sell. So at that price, you really need to move of 10% higher or more just to break even on any physical gold purchases. You've also got the storage costs and some other risks, as far as robbery and that kind of thing with physical gold. And with stocks, on the other hand, you can invest in ETFs or funds like the Spider Gold Shares, which is going to hold physical gold and then sell shares in that inventory. But really, the investment I prefer, the one I like the most, is investing directly in the miners. With the miners, you don't pay those expense fees like you would get with the Spider Gold Shares. You also get an investment in a company that's producing profits. So we'll look at the returns chart here again. That GoldMining Inc. is in green, the Gold Miners Fund, the GDX, is in red, and then in purple, I've added shares of the GLD Gold Fund. And what you notice is that the miners and then GoldMining Inc. here give you the potential to vastly outperform gold prices on that return. These are leveraged companies that not only are benefiting as the price of gold increases, but also as just from good management that are producing those higher profits. So I do like gold here. I wouldn't be jumping in with everything I had, but I do have just over 5% of my portfolio in the asset through physical holding and some gold miners. Besides that potential return, like we talked about, this is going to be one of your best assets for those what-if scenarios, like another stock market crash or just that general trend lower in the value of the dollar. Check out GoldMining Inc. That's ticker GOLD in Toronto or GLDLF in the United States. And don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.